This video is called Unsubscribe Buttons, a Doc Strike, and Cash Flow. So I don't know about you, but I'm noticing something, and that is when I want to unsubscribe from emails, I'm seeing unsubscribe processes that are more and more difficult to use. And as this article says, top 10 design mistakes and unsubscribed experience, canceling email subscription should be a one-click process with no additional hurdles. I'm seeing lots of additional hurdles. I bring up unsubscribe buttons because I think that people are intentionally making it more difficult to unsubscribe. That's what I suspect. And this is the natural transition to another suspicion, and that is companies that suspect there may be dock strikes that affect the supply chain. Potential port strikes. So U.S. importers are pulling in goods as early as possible because of a risky port strike that could occur. Retailers and manufacturers are rushing in merchandise and pushing shipments to other gateways as walkouts on the East and Gulf Coast grow more likely. We got to meet consumer demand. U.S. importers are rushing millions of dollars worth of goods, electronics, holiday goods, industrial materials to get ahead of a possible strike by dock workers in less than 2 weeks that's threatened to lock down major points and hammer the U.S. economy. We saw this happen during COVID. We had tremendous problems with shipping during the pandemic that really impacted a lot of businesses. As an example, this company, Balsam Hill, still has millions more items to ship and faces a financial toll if it can't get its goods to the retailers ahead of the holiday shopping season. So imagine you're in this situation, you're a retailer. What is the cash flow impact? So this is a chart that I've used, and I've narrowed it down. I've got a more complex version. So if you can imagine that Acme Retailer is a retailer, and this is their cash flow roll forward for a 3-month period. And you can see we have beginning cash balances, inventory purchases is an outflow in parentheses, sales, which I'll explain in a minute, and cost of goods sold, which is what they're selling. So to explain how it works, in July, in red, they sold $300 worth of merchandise. They collect $240,000 here. They collect $60,000 here, as an example. The cost of goods sold for those items that they sold, $195,000 in red relates to these sales in red. $234,000 relates to the sales in blue. So that's sort of how the chart works. So here's the big point of this chart. Let's say that the company suspects there's a strike and sharply ramps up their inventory purchase from 100 to 300 to 500,000. But sales aren't increasing at the same rate. We sold 300, we sell 360. Maybe in September we sell a little less, 270. I haven't projected it out that far, but you get the idea. Cost of goods sold relates to what you sold down here. The point being that what you can see is that the ending cash budget, the ending cash balance starts to go down. So as you spend more and more dollars out on inventory, your sales aren't increasing at the same rate as the inventory purchases. Your ending cash is going to get lower. And that's what could happen to these companies is they spend a ton to get the inventory in the door so they don't miss out during a dock strike. They spent a lot of cash, a lot more than the sales that are going on during those inventory purchases, and the net result is ending cash goes down. So the takeaway here is if you suspect you're going to have a big and unplanned, unprojected cash flow outflow, think about whether you need to go out and get more financing. Because if you don't and you have that bigger cash outflow, your ending cash balance may start to go down dramatically.